Looking ahead, we foresee inflation to be stickier and longer lasting, with slower economic growth, particularly in the US and China. In Europe and the UK, we continue to forecast ongoing stagflation. Despite the muted growth outlook, the expected pivot by the Western central banks has the potential to be supportive for equity markets and for quality growth stocks in particular. Although we note that expectations of rate cuts over the next 12 months have become very aggressive and therefore could fuel some volatility with each data point on inflation and each central bank meeting. In our view, we are effectively in a hawkish dove stance. Central banks are signaling or already taking steps to cut interest rates, but might only do so in a timid manner until they are clear that inflation has been tamed. European and Asian equities currently offer more valuation support relative to history and relative to other developed market equities, although both regions also carry a higher geopolitical risk and are more cyclically sensitive. On earnings, we expect growth to be fairly pedestrian. Corporate earnings growth remains mixed following the most recent season for the second quarter results. Earnings momentum is deteriorating and has turned negative in some regions, despite technology and communications seeing upgrades, with other sectors having reported weaker growth and seen estimates downgrades. We increased our top-down earnings growth forecast slightly for the year to plus 6% from plus 4% previously at the global level, which remains below consensus. Overall, we still view economic slowdown as a central scenario in the next 12 months. We also maintain our probability of recession in the 35 to 40% range. So not the central scenario, but not a negligible risk. We know that some economists have been increasing the probabilities of recession upwards closer to our range in the past couple of months. Ultimately, when an economic slowdown is met with interest rate cuts, equity markets should be somewhat supported in our view, providing that we do not enter into a prolonged recession. Additional political and geopolitical risks remain high, notably with the upcoming US presidential elections, which bring an element of higher uncertainty on policy direction. As long-term investors, we are investing in some attractive structural growth trends around artificial intelligence, energy transition, and aging populations, which offer good long-term prospects, although we believe it is critical to maintain valuation discipline to capture the pockets of these themes that will still have valuation support. We do see signs of froth emerging, notably in the AI theme, and have been selectively positioned in areas where we can find strong support from fundamentals and valuations on companies that can more meaningfully monetize the AI opportunity.